I want to talk about, I know we'll probably hit crypto, but I want to talk about the equity markets because you had tweeted out something you always tweet out interesting stuff, but the other day you talked about the Fed. You did a podcast and you sort of half in tongue-in-cheek joked, I knew the Fed would send out their doves to message. I didn't realize it would be today, meaning a couple of days ago. The stock, Wall Street, Morgan Stanley, Goldman, they think we're going to get anywhere from 4 to 7 rate hikes. Sounds like you think we're going to get less.
Oh, I'll take the under all day, Brian. I'd be surprised, not if we got 0, but I think 0 chance we get 4 to 5. So Friday morning, I recorded this podcast and we talked about how the Fed had gone from, Jerome the Hawk to Jay the Dove over the last few years. And the markets didn't like this return to his hawkish nature. Markets crashing all during January. And I thought that it wasn't going to be long before they sent out the other Fed commissioners to start hinting that, well, maybe they didn't have to raise rates. And literally that afternoon, Kashkari was out saying, oh, well, we could stop in the middle of the spring. So I think they're afraid. And I think they're in a box. They really don't have any choice. They've had us in financial repression really since the global financial crisis. We've got emergency rates. There's no emergency anymore. We're not, as you said, we're not in the global financial crisis like we were in '08. But they've manipulated interest rates for so long, they've forgotten what it feels like to have a naturally functioning market.
And that's kind of the weird irony. And I don't want to rewrite history, okay? We go into the pandemic. We don't know what's going to happen. We didn't realize that millions of people are going to pass the days by online shopping and spark inflation in certain parts of the economy, or millions of people decide they want to do something better with their lives and they quit or they move. We didn't know any of this then. We know it now. In retrospect, seems like kind of a bad idea that the Fed bullied up its balance sheet so much, anticipating some kind of a crisis. And I think you're exactly right, Mark. How do they forget about interest rates? How do they unwind that balance sheet?
Yeah, look, who's going to buy all those bonds that they own? And this is no different than Japan. Japan in 2008 said, we're going to end QQE. They had an extra Q for qualitative and quantitative easing. They're still doing it. Crazy Kuroda-san was out in force last year, weakening the yen. Everybody thinks the dollar went up last year. It didn't. It just went down less. It actually fell versus the renminbi. It's just that the Bank of Japan printed more money than the ECB, than the U.S. And when governments get in huge debt, they can't afford to have higher rates. So we're going to be stuck in this financial repression for a very long time. It's why this morning we are launching a new ETF, CSH, for investors to get some sort of yield on their cash. It's a really tough situation out there for savers.
Well, congrats on the new ETF. What's in that? Is it a cash equivalent? It's not a money market fund, is it?
Not a money market.
Composed of crypto? What's in it?
No, not crypto, not money market. It is actually SPACs. You own the SPAC before it de-SPACs, so you don't own the post-merger combined entities. You own the SPAC, which is invested in a portfolio of treasuries. That's the nice thing about a SPAC. There's a lot of misinformation about, or misunderstanding, not misinformation, misunderstanding about SPACs. A SPAC is a blank check company. It's a pot of treasuries. You get those treasuries plus warrants on the company that it merges with eventually. So we hold the cash, we get paid the interest, then we hold the warrants and we sell the security when they announce the deal. So we only hold pre-merger, and then we get the warrants for the upside. And we've compounded in a hedge fund structure in the mid to high teens using leverage. This is an unlevered version. We think will generate mid to high single digits over the long term.
Because SPACs, the stocks, Mark, many of them, as you know, have not ended up very well for investors. So you want to make it clear, this is not buying baskets of the stocks. This is the pool of money used prior to doing some kind of a deal. It's a very different thing.
Very, very important. The SPACs, there's a lot, like I said, it's misunderstanding. A SPAC is not a company. It is a pot of money that is used to do an initial public offering. The de-SPACed companies like Virgin Galactic or DraftKings, those companies, they'll do well or not do well the same way that Amazon or Google or other companies have done well or not done well. But those are companies. A SPAC is a trust of treasuries. And if you sell for that, you get your cash back before the deal is announced, or before the deal is consummated and the SPAC de-SPACs. It's a great arbitrage. One of the last arbitrages left, kind of like merger arbitrage or convertible bond arbitrage.